Opportunity Zone. I'm Nate Armstrong. I don't have my co-host today, Chris, and maybe it's a good thing. I got to show him the mail that I got. Somebody was not a fan of a comment that he made, but that happens sometimes because we speak the truth here and we're just going to unveil it like it is. Okay, so much to cover today. Before I jump into all of the headlines, just know this, there is a new Fed chair candidate. He's not in yet. May 15th, Jerome Powell, his term expires, but there's a new Fed chair candidate that's getting grilled on Capitol Hill this week. We're going to talk about the implications of that to you as an investor. We're also going to talk about what the heck is going on with the foreclosure filings. They're up 26% year over year. How? Why? Will that drag down the market? How will it affect you as an investor? We're going to get into that. And then I got a big one on multifamily insurance companies. They're finding a lot of risk in different categories of multifamily. So if you're thinking about investing in, or you're about to start investing in multifamily, then this is definitely going to be an episode you don't want to miss. We're going to get into all of that and so much more inside of this. I also got, spoiler alert, this is literally, I'm going to break down segment by segment which rents are rising and falling the most according to bedroom mix and then asset class. So if you're really on the fence thinking like, which one do I do? Follow the trends. I'm going to release those on today's show. All right. How we start things here is we're going to do a proverb, and the proverb today is 10:22. And it goes like this: the blessing of the Lord makes a person rich, and he adds no sorrow with it. What does that mean? That means that true prosperity, we're talking like true inner happiness, joy, peace, and the wealth that comes along with it, that comes from God's favor, rather than just being a, superhuman with superhuman efforts. It comes from God, really, okay, from God's favor. So Proverbs 10:22, remember that one. And now I'll kick things off. Dear Lord, thank you for this opportunity just to shine some light on this week's news for all of our investors that are out there. I ask that you help me deliver the words that help somebody on their journey, regardless of what step that's at. Let's help them on their journey so they can get the financial literacy concepts that you feel are important. Also, we pray a blessing over Chris in his travels back to the home office as he's coming back from a conference. Amen. All right, guys. I got a lot to cover in a short amount of time to do it, so I'm going to jump right in. And the first thing up is these foreclosure filings. Literally, I don't know how this happened. Actually, I do, but I don't know how it got so fast, so quick is what I should be saying. So what's going on right now, this is single family. I'm going to bounce back to multifamily in a second, but single family foreclosure filings are up 26% year over year. That's massive. We haven't seen a spike like that probably since 2010, 2011, somewhere in that era. So for foreclosure filings to jump that fast, you have to understand the context. And the context is that during COVID, there were a lot of bans on foreclosures. A lot of states literally their hands got tied. The federal government under the Biden administration put out a moratorium or a foreclosure freeze. So for any Fannie Mae backed loan, FHA loans, which is the majority of them, they couldn't be foreclosed on. And so consequently, you have some of those old COVID policies that held up the court systems. And now all of a sudden, they're at a breaking point. Now all of a sudden they're free, and these lenders that haven't been paid in quite some time, they're able to freely foreclose. And so now we're seeing it. So 26% year over year hike. Now, you might say, well, Nate, does that mean the sky's falling? Are single family house prices going to come down? Real estate's a very location specific thing. And I think in some markets, it's going to drag. It's going to be an anchor to hold prices back. But for the most part, in most markets, I don't see it happening. I just don't. There's not enough. The underlying toe, the market strength is not strong enough with those foreclosure filings to take down all of single family home prices. Plus, we have a presidential administration who has come out and said, we're not going to let people lose equity in their houses. Now, they don't control everything, but they're making a concerted effort right now to keep the value of homes up, even in even in spite of some other things that are going on and the headwinds that they have. So I don't see it happening. I don't see it being a nationwide wipeout. Plus, there's still a shortage of housing in this country. The biggest reason houses aren't selling right now is because mortgage rates are high. It's like, why would I sell my property when I have a great mortgage rate on it to move to a different property where my mortgage is going to cost me double? That's what Americans can't reconcile with. So that's why you're not seeing houses sell right now. All right, next up, mainstream insurance companies. They're getting squeamish about the risk in multifamily. Well, what does this mean? Well, in addition to what they're citing in this article about basically there's some headwinds or softening in the rental market for Class A buildings. So remember earlier I mentioned this, but which buildings, which type of properties in which asset class are going to have the best boom in the coming years, and which ones are going to have the most headwinds, the most resistance? Well, this insurance company, they're saying right off the bat that they're seeing Class A softening. Okay, so that concerns them as an insurance company, that rents are softening in Class A buildings. So that's clue number one. I'm going to get to clue number two in just a couple of minutes. But Class A buildings are seeing a softening, whereas workforce housing remains resilient and structurally, these are their words, structurally undersupplied. So workforce housing, they're giving the nod to, they're giving the thumbs up. Okay. The other thing that they're saying about multifamily insurance specifically is that there's a lot of risks associated especially when they're financed by the major institutions like Fannie Mae, Freddie Mac. And that's where they get into this. They're saying agency lenders such as Fannie and Freddie, they require, right here, assault and battery coverage for loan compliance. However, many insurance companies no longer offer these protections, especially for aging, affordable, higher crime properties. So what this is saying to us is that there's insurance companies that are going to step back from covering some of these, I don't want to call it incidentals because it's a horrible crime to see assault or battery or anything like this, but insurance companies are stepping back from that. They don't want to be the one taking those lawsuits on when the tenant sues about some incident that happened in the apartment or somewhere on the campus. So they're stepping back from it. In fact, I heard about it first last year. We have an investor of ours who he happens to own a multifamily property in Memphis. And he called me and he said, "Hey, Nate, on the building that I own by myself," this is nothing to do with home investment. He said, "On the building that I own by myself, the insurance company doesn't want to cover this incident that happened between a tenant and some guest that wandered onto the property." And then we started getting into the mix of it. And I uncovered in that conversation that it's exactly this. Insurance companies are stepping out. They don't want to. And so these exclusions are getting bigger and bigger and bigger. So if you are a multifamily operator, you're thinking about getting into the multifamily game, you really have to ask the question, or if you're going to be a limited partner, a passive investor, you really have to ask the question, hey, what type of insurance do you have? Does everything get covered? It's forever been known that insurance companies like to make these exemptions for things like Oklahoma City. They don't cover wind and tornadoes very easily in Oklahoma City. Why? Because it's the tornado capital. It's tornado alley. It's tornado capital of the United States of America. Therefore, you just know that you're going to pay a premium for that type of coverage. But it's new to now have these extra coverages being stripped away, assault and battery type coverages. So just be cognizant of that. Whatever deal you're getting into, make sure that the proper insurance coverage is there, it's in place, all that kind of stuff. Okay, clue number 2 on which type of asset is the best going forward. And for multifamily specifically, I need you to pay attention to this. 2-bedroom apartments are the leaders in declines right now. Yes, that's right. The rent is dropping on the larger stuff, the 3-bedroom units, the 2-bedroom units. They're citing the 2-bedroom units in here, whereas the 1-bedrooms are holding their own. This is a fundamental shift in the marketplace. For a while, we actually saw people kind of rooming up. They needed more space, and they would split spaces and things like that. Now we're seeing people that they really want their own space, but they're downsizing to get it. They're willing to cramp maybe 2-3 people into one single apartment, as opposed to trying to stretch it out into a 2 or 3-bedroom property. So when you're investing in a deal, look at the unit mix. Check it out. Is there a variety? Are they singled out as 3 bedrooms? Check that out. It's really, really important because right now we're seeing the bigger stuff that's actually slipping on rent declines. It's the leader for rent declines right now. Okay. By the way, if you are looking for an investment, know that Home Invest just opened one up. I know there's been a lot of people waiting for a long time. We opened up East Ponce Village. We just opened it, and we're well over halfway there on our subscribed funds for it already. But if you're looking for a deal, I'll tell you about this one really quick. It's a 977 unit apartment building in Atlanta, Georgia. This is literally the 5th largest deal in Atlanta, Georgia. It's gorgeous. Okay. 1984 construction, and you can kind of see the video as it's zoning through here, but it's on 99 acres. The only reason that this came to be is because the operators of it, they failed to prepare for some of the turnovers. They got into a money crunch situation, and they turned to us, and we stepped in to solve their money crunch problem. They have a great loan on it that we're assuming, literally the assumption on the loan, it's at $71 million. It appraised for write this down. It appraised for $122 million. Imagine getting into a deal on a loan assumption for 71 that appraised for $122 million. Okay, we're going to go in and finish what they weren't able to by injecting a little bit of capital. We're doing it, basically we're turning the units that they weren't able to turn, and we're going to finish the job. And then on the backside of this, after our investors make their profit, then we're going to cut the original owners back in. Those investors deserve a second chance, and so we're going to give it to them. So this particular deal, this is for anybody who's trying to reduce the amount that you have to write to the IRS. If you're thinking, or if you have to in the past write the IRS a big check, check out this deal because it has up to 100% bonus depreciation in year number 1. That's massive. I've been in this game for a long time. Usually you can squeeze out 30 to 40% bonus depreciation in year 1. This is up to 100%. So for someone like me, who, God willing, I'm going to finish this year like I have the previous 5 years and do very well, I'm going to literally be able to wipe out my taxable, what I would have to write a check to the IRS for. Let's put it that way. There's rules to it. There's a proper structure that has to be done. If you're curious about that, then just reach out to our team. Put the word book, B-O-O-K, in the comments, and our team will reach out and we'll get you the link. Or you can click the link that's in the show notes, and our team will get you hooked up. We'll get on a call with you and walk you through how that works. Okay, moving forward. We have right now immigration policy that has affected multifamily trends. Okay, this is from John Burns, huge data house. I'm a data geek myself, and so I like reading John Burns stuff late at night on Saturdays when my kids are in bed. But his team pulled out some of the immigration policy data, and it's not shocking to me, but it's something that I think everyone that's getting into multifamily needs to understand. Okay. What's happened is we had the border essentially shut down. So net migration coming into this country is at historic lows. Even legal immigration has been cut down dramatically as opposed to past administrations. And so unlike the past, where basically apartment buildings and especially some of the workforce housing that was out there, a lot of that occupancy is no longer being filled by the same occupants. Okay. Couple that with a low birth rate right now, there's not a lot of people coming in for that. Okay. Household formation, that's the stat that they use there. That's basically, it's not happening in the strides that it used to. Okay. So the impact of that, it's hurting some leasing and some occupancy in some cities. Now, I have to be very, very clear with this because real estate is a very local thing. You can't just take a headline like this and say, look what's happening in the entire country, because it's not true in the entire country. It's true in sectors of the country. It's true in population hubs like, for example, Lexington, Kentucky. That was a city that was pretty pro-immigration. They were letting a lot of folks come there that maybe shouldn't have been there. I don't want to go as far as calling it a sanctuary city because the state itself was not a sanctuary state, but the city sort of was. It was very, very relaxed on that. And so when the ICE raids started happening, we saw a lot of tenants literally skip in the middle of the night. That means that they just disappear. They stop paying rent. They change their phone number or they got rid of their cell phone and they're gone. We saw that. We also saw contracting prices increase in Lexington because a lot of the workforce for contracting just disappeared as ICE came through. And so it had a big impact on the cost to do business and the occupancy level overall in Lexington. Okay. But it's not true everywhere in the country. We still have migration happening. Last week on the show, we actually covered why a lot of people are leaving California, why a lot of people are leaving New York, and why they're going to Texas, Florida, and South Carolina. And so it's very important to watch these kind of moves that are happening, okay? Because right now, Texas, Florida, and South Carolina are still booming. People are moving there. It's net positive migration, even though immigration from external sources is down, there's still net positive migration in some sectors of the country. Those are the places that we're leaning into. If you look at the deals that we're producing, like for example, Atlanta, Georgia is still growing. People are still moving there. Got ranked number 2 in the country. And so we're looking at investing in places like that where we've got net positive migration. People, the population's increasing. Okay, next one. I want to get into the markets that lead the latest multifamily risk and reward. Okay. This was done by Arbor Realty Trust. Okay. And basically, number 1 market, they rank Indianapolis first among 50 of the largest markets in the country. That's, they're saying it's reflecting on how steady and well balanced it's performing. Okay. I want to also comment on the top 10 on this though. Okay. Indianapolis is a great little market, but let me hit the top 10. So they're saying Raleigh, North Carolina, Salt Lake City, Nashville, Milwaukee, Wisconsin. We own a lot of real estate in Milwaukee. I've had the blessing of doing business there now for going on probably 13, 14 years. Still have good stuff up there. Some of my first multifamilies in my life were bought in Milwaukee. Anyways, Milwaukee's on the list. San Jose. We do not do San Jose, not because it, made this list or didn't make this list, simply because California is a state that we can't predictably project what our investors are going to make. And we don't want to be in a state that basically the government can clamp down and beat up the landlord. We just don't want to be there. We want to be places where we can always hit the return metrics that we promise. Charlotte's on here. We're looking at a beautiful asset in Charlotte right now. We'll see if we get it, but we're getting pretty close. Chicago's on here. We used to do Chicago. We do not anymore. Again, we just don't want to get into a state that potentially could be mean to landlords. My original home state, not anymore, but my original home state, Minnesota, you guys have probably seen some of the headlines of what's happening in Minnesota. We don't do business there anymore. We've done well over 100 different assets in the state of Minnesota, but we don't go there anymore because they instituted things like rent control. And unfortunately, those things usually punish the landlord, and we just don't want to be part of it. And then we'll round out the list with Richmond and Phoenix. Okay, that's Globe Street's top 10 list right now. All right, next up. This market's very different than most right now. And what I mean by that is if you're not a good operator, if you're not rolling up your sleeves, figuring out how to retain tenants and literally getting them to stay longer and renew each time the renewal comes up, you're probably not performing very well in your real estate. If you're relying on new tenants coming in all the time, it's not that kind of market. You see 3-4 years ago when everything was booming and prices were rising and people had COVID money and all that kind of stuff, COVID stimulus money, what was happening is that operators could literally just keep raising rents and they'd have an influx of new tenants coming every single month to a property. So they could keep achieving higher and higher rents and they could cover up any of their bad operating mistakes. We're not there anymore. Now we're in a market that you got to be really, really good. And I want to point out in this Globe Street article, this one, they really outline in here, basically this period of time is about operations. Okay. And so what does that mean? That means that our job is as an operator to maintain tenants. What we did, we partnered with this group. They're a nonprofit called Apartment Life. Shout out to Alex over there. And so we have an on-site minister that's at the property. We pay for that. And what their job is not to go there and preach. Their job is to build community. They're very good at building community. And what they'll do is they'll hold resume building workshops. Write that down. That's a huge note for anybody that's getting in this business, okay? Resume building workshops. Why? Because if you can teach your tenants how to make more money, they like you. They want to stay longer. They want to be part of that. What about after school programs for the kids? Okay. What about instituting a point system that every time they fill out a tenant fills out a feedback survey, they get points in a resident portal that they can be cashed in for prizes and things like that. These are the kinds of things that have to be done to retain tenants, okay? The folks that get the best at retaining tenants the next 2 years are the folks that you're going to see winning with their assets on exit, okay? All right. I gave you clue number 1 and clue number 2 on the best asset class, the best unit mix. I'm going to give you clue number 3, and it's right here. Class B apartments quietly outperformed the other classes. What does that mean? Well, they pulled the data from Yardi, one of the largest property management softwares that are out there, and they compared Class A, they compared Class B, they compared Class C, and basically Class B was the winner right now. Class A was dropping. Class C had some struggles for various reasons, but Class B edged them out. And so this is kind of the perfect mix. Remember to avoid the big 3 bedrooms and make sure you have a healthy mix between 1s and 2s, and then be in Class B. That's what they're saying in this article. I would argue and say go for C+ to B middle, somewhere in that range. And that's where I feel most comfortable right now. I would shy away from Class A because Class A is restricting as we speak. All right. You guys hear about the Fed chair? Jerome Powell is literally on his way out. May 15th, this man's out. And they're bringing in somebody new. And that man, it's probably going to be Kevin Warsh. He's got to get confirmed. He's got to go through the grilling on Capitol Hill. But this man, he's coming up. And somebody got a hold of his speech ahead of time and they released it to a newspaper. And I don't know if it's really his or not, but in his speech, basically he's saying in here, I'm going to remain neutral. I'm not going to be swayed by any administration or any politicians. I'm going to remain neutral. I'm going to do my job to keep the Fed independent. Now, what do you think? Do you think he will? This man was handpicked by Trump. I want to say the Trump administration, but even Donald Trump himself has called out this man and said, Kevin Warsh, Kevin Warsh, Kevin Warsh. And this man, remember, Donald Trump wants rates to go down. He does. He's made that abundantly clear because he knows that will lift everything up. Borrowing starts to happen. Companies will borrow money, and us multifamily investors will borrow more money when rates are down. And so he's hoping that Kevin Warsh will execute that. But the last couple of months since the war broke out, we all know that rates haven't been going down. In fact, I've gotten some rate quotes that have gone up since the war broke out. So what will Kevin do? Let's find out. Okay. I'll be sitting here waiting too, but he's getting grilled on Capitol Hill this week. Next up, we have something I reported on about a month ago, but now it's real. The Texas Stock Exchange, Dallas, no longer New York. They're opening in Dallas. Yes, New York still has the New York Stock Exchange. Don't get me wrong, but now they have competition for the first real time. I mean, I guess the NASDAQ is competition, but this is the first time they're going to have a second city doing a stock exchange in the United States of America. And so Dallas is really excited about this. They're going to have 3,000 or so jobs right out of the gates, and they're planning on adding more. And so this could be a real big hit in Dallas. This could bring a lot of jobs downtown, and we could see some values increase on multifamily because of this. So let's watch. Let's hope. I hope it does really well. I think that healthy competition is good for every sector of business. Now, this next article I caught, and I think it's really important, why the IEC, okay, this is a group out of California called Interstate Equities Corp. They buy multifamily, but why they are converting to student housing. They're literally, in this article, it outlines and says that they're taking an existing standard multifamily property and they're making it into student housing. Now, the first reason, and let me set this as the anchor, but I want to give supplement on this. The first reason is because this property happens to be close to Davie, okay, big college in California. But the second reason is because the rent by the bedroom model is catching on. I don't know if you've heard of Pad Split yet or not. Pad Split might want to pay us to be a public promoter. I'm just kidding, Pad Split. We use Pad Split on some of our properties to rent out some bedrooms here and there too. But literally what's happening is that there is a segment of the population that would rather have a short-term commitment and rather just rent one bedroom. And that's the way they want to live life right now. And that's a new thing. The last 4 or 5 years has really brought that on. And so IEC is leaning into that. They're taking a functioning multifamily property right now and converting it into a by the bedroom rental. So watch that trend. I think it's actually going to get a little bit bigger as time goes on, especially as people feel uncertainty on, buying a house. People don't want to buy a house yet. Okay. Next one, Hilton. Oh my goodness. Hilton Hotels. They just unveiled their first apartment. Yes, that's right. Furnished apartments. Okay. They're now playing in, some people might call this the short-term furnished or mid-term furnished market. We have a couple of clients that we get a chance to consult for their business. They're heavy into this mid-term rental space, but now their competitor will now be Hilton. Hilton wanted their own apartments. And so now they've launched. And the thing I want to point out in this article is it's not just Hilton that was thinking about this. Literally, they're naming in here that Marriott is right behind them, Wyndham Hotels, and they're all partnering with like big players in the space. Casa Hotel is entering as well. So watch out. Why are all these folks in the hotel business now entering the multifamily market? You think they know something that maybe we don't know? I think that they just realize where the trends are shifting. I think people like these, rather than being stuck in a hotel room, which is basically a closet, a bathroom, and a bed, people really like to have kitchens and couches and a place that they can call home when they're there. For me, I know I travel. I jump on a plane tomorrow, and then I got to fly up to, I go to Atlanta, and then I go up to Dayton, Ohio. I'd like to go back to a kitchen. I would. And I think that these hotel companies are recognizing it, so they're now entering the apartment game as well. Buckle up for that. Okay, last but not least, guys, I'm going to put up and give a little bit more detail on this East Ponce Village deal up in Atlanta. This is the deal. Literally, it's the deal of the year. It's probably going to go down as the deal of the decade. And I'm not saying that lightly. I've been at this game now for a long time. I've had the blessing or privilege of doing well over 1,000 properties. I've been able to take them full cycle, bought them, fixed them, rented them, sold them, refinanced them, pretty much everything in between. And when you have a deal that you can get into at a basis of low 70s and it's appraised for 122 million, that is, it's really hard to achieve those numbers. It's really hard unless it's like a dumpster fire. And this is not a dumpster fire. This is a situation where the previous ownership group, they got into a bind cash wise. They didn't plan for some unforeseens that came up and hit them. It's a 1984 asset. And in 1984 assets, you got to plan for roofs. You got to plan for HVAC work. You got to plan for plumbing. And some of those things popped up and kind of bit them. And consequently, they had a great asset, but they just underplanned their capital reserves. And so we're stepping in and we're saving them. We stepped into the controlling position and we're funding all of the capital expenditure stuff that it needs to get to the finish line. And then once it's done, then we're in a spot where we can have a liquidity event. That means either sell it or refinance it if rates are really good and we can make all the investors whole and all that kind of stuff. So, but that's what's happening on this thing. And it's a deal that we just put out to our initial investors. We always send stuff out to core investors first, and we filled over half of it. Half the commitments came in right away, and there's still conversations happening. Actually, there's a conversation that's happening in person in 2 days that might gobble up 5 million, which will push it right up to the brink of being done. But if you're looking for a deal where you get alongside of institutional quality operators, folks that have seen stuff through full cycle, folks that don't give up in the middle, we finish the job strong, then this is the asset for you. I think it will go down as the deal of the decade. I think that 4 or 5 years from now, we're going to look back at this one and say, holy cow, I wish I could have found 3 of those. And the only reason it's even available in today's marketplace is because cash right now is king. It really is. In a marketplace where there's a little bit of fear and uncertainty, you create a cash shortage. And so that is our advantage. We get to step into it while everybody else is. Well, Warren Buffett used to say it best. He used to say, when everybody is greedy, you should be scared. You should run, really. And he said that when everybody else is afraid, that's when you should be greedy. And this is the point that we're at right now. Our institutional partners, the folks with big money, like this group that's probably going to do 5 million, they get it. They're being greedy right now. They're grabbing stuff. And so that's the position we're at right now. That's why I'm personally investing in it. My business partner's investing in it. If you've got interest in it, then let our team know. You go just write the word book, BOOK, like book a call, book in the comments, or see the show notes, see the link there, and you can use that link to book a call with us. All right, ladies and gentlemen, appreciate you. Remember to invest with purpose. Thank you. Bye.